evening, everyone. Welcome to this webinar on consumer tech business in India, opportunities and challenges by Avendus Wealth. I'm Devashish Gaur from the Investment Solutions Group at Avendus. On this topic, we have with us Mr. Ramesh Mantri, Director Investments, White Oak Capital Management. Ramesh has a rich experience of over 17 years in investing and financial analysis across sectors. Prior to joining White Oak, Ramesh was a founder of Ashoka Capital Advisors and advised family offices and on fund and equity investments in South Asia. Ramesh, welcome and agreed to do this for us. The format for today's presentation would be approximately a 45 to 50 minute discussion on the topics where Ramesh will touch upon consumer tech, how is it panning out across India, opportunity funnel and where are the profit pools, how do you evaluate such businesses, and lastly, key enablers. Post which we'll open it up for Q&A and then take it up from there. Ramesh, over to you.
Sure. Thank you, Devashish, and thank you, Team Avendus, for hosting White Oak to present at this event. Good evening to all the participants of this webinar. I'll share the presentation now. Before I start off on this topic, and I hope you're able to see this presentation. I hope you're able to see the presentation.
Yes, it's visible. Yes, it's visible.
Sure. So, just giving one short background about White Oak Capital. We are a 4.5-year-old India's, specialist, equity specialist. And the firm today manages, based on the best-in-class performance that India's White Oak funds are delivered. Today, the firm manages 43,000 crores in India equity AUM. And the firm was founded by Prashant Khimka, who was previously 17 years with Goldman Sachs in various leadership roles in US markets, and also as the CIO of the Goldman India Fund and the Emerging Markets Fund previously. And I'm sure you followed the news that White Oak has recently acquired the AMC business. So from moving from offering PMS and AIF products, we will incrementally start offering the mutual fund product in the next few months. So starting about consumer tech and fintech India, opportunities and valuations, because most of the challenges are now about the valuation part, right, as investors. So that's why I changed the topic from opportunities and challenges to opportunities and valuations. And so first is the question that emerges is why should we talk a lot about these sectors now? And the reason is that these sectors have come of significant age in India in the last 5 years. This has happened 20 years ago in US with the emergence of Amazon, 10 years ago in China with the likes of Alibaba, Tencent, Baidu. So what's happening in India is not new or unique. In fact, we are behind we're surely behind just about every developed markets. We're also behind a few emerging markets. So this is a movie that has already played out in other parts of the world. And people have seen that these kind of new age businesses have disrupted number of industries and also created large winners. And so it's important to understand this space now for two reasons. One is the fact that you may choose to invest in these companies. And it is expected that in the next decade, 25 to 30% of the India's market cap would comprise of these companies. This is exactly what has happened in the US and China. Number two, even if you choose not to invest in these companies in the short term, a lot of these companies will start disrupting existing profit pools across industries. We started seeing in e-commerce with the emergence of scaled e-commerce, right? Starting impacting retailing. You are seeing in the emergence of health tech platforms is a risk to pharma distribution and even pharma companies' pricing power. And in fintech, a large number of new fintech startups are a significant risk to existing profit pools in in the BFSI sector. And in this presentation, we will talk both about consumer and fintech. And fintech is obviously now a lot more topical in the fact that we had two IPOs of fintech companies, two with very different outcomes, right? And we'll talk about that, and I'll take more questions in the Q&A. So one, these sectors are growing rapidly, and you have already number of scaled companies have emerged across different vertical platforms. So one, you have the industry leaders and players in the specific verticals. On the other side, you have enablers who enable these businesses, from delivery companies to someone like Khata Book, which provides easier accounting platforms, to Razorpay, which kind of helps to build the rails to connect to the payment platforms, right? So we are seeing an ecosystem of large opportunities in tech, and that's why it's important to spend time on this now. Now, starting at looking at the funnel of opportunity, just about for every business, the largest top of the funnel is the population of the country, about 140 crore people. But the next important funnel is how many people have smartphones, 4G connections, which is half the population. And then what is the digital payment penetration? This number is 25%, but growing very rapidly and is likely to hit 60%, or maybe the number is even higher than 60% in 4 years, at the pace at which we are seeing rapid adoption. Again, online transactors are again people who are using the internet for a variety of transactions, again, has gone up quite a bit. It has become a scale number. And remember, these numbers, while today still are a fraction of the India's population, when you compare with a lot of other countries, they're actually equivalent to their population. So that is the perspective you need to have, that already the Indian internet is fairly scaled when you consider a lot of other countries. At the same time, when you think about a lot of services in the country, they are significantly underpenetrated. And we have given a few examples of financial products, and we'll expand that in the next slides later in the presentation. So what is fundamentally the core value proposition of consumer tech and fintech? Fundamentally, in India, in a country with poor infrastructure and such large and, access is very difficult. Consumer tech companies solve many problems. One, they solve the basic problem of availability, that there's a lot of product that is not available in certain parts of the country. For example, for companies like Amazon, Nykaa, Flipkart today, 65% of the sales come from tier 2, tier 3, tier 4 cities. Where we are, of course, live in large metropolitan cities where usually availability is less of a problem. But in a lot of parts of the country, just making the product available itself is meeting a huge need. Number two, a country like India, with its high population density, at the same time, very expensive real estate. India has, if you compare India with US, we're exactly the opposite. We are actually a mirror image. US is expensive on labor and cheap real estate relative to labor cost. India is the opposite. And the e-commerce model, which fundamentally does not need prime real estate and needs a lot of labor, is more suited to the Indian market than even the US market. And China is exactly same like India. China is long labor, short real estate. And that's why in consumer e-commerce penetration in China, which started much behind US, while US is still high teens penetration of e-commerce, China is already in early 30s and India is still in single digit. So it's likely that decades time, a country like India, e-commerce penetration is higher than even US market, just because e-commerce is more suited to India. And of course, these companies, they pass on these scale benefits, they don't have the cost of real estate to consumers through affordable pricing. They deliver great customer experience. Imagine How many physical businesses allow you to return a product without no questions asked? That itself is a great experience. They provide tremendous convenience. Imagine trying to book train tickets in stations, right? To the current experience of buying on a few clicks of a button a train ticket. They're providing convenience. They're providing significant speed at which transactions happen. Today, in a few clicks, you can buy a product. And of course, these platforms are providing tremendous personalization. Today, an Amazon or a Flipkart website or a Nykaa website knows from your, or a Myntra knows from your past behavior. For example, Myntra can recommend you your sizes based on your product purchases in the past. Similarly, all these apps are able to understand what you need. They, in fact, can guess the demographics of your house by the basket of products you have bought. If you bought sports equipment, cricket bats, they know they have a child at home. If you bought baby care products, they know you have a young baby at home. So they're even able to predict your age and demographics by using data to understand what kind of consumer you are and offer personalization. So the value proposition that consumer tech offers is unparalleled. And that is why, while they found global scale-ups and success, it is bound to happen rapidly and scale up. And things like even reviews, right? If you're trying to buy a product that is not known, earlier the way was to find someone who had used a similar product. Today you can look up, read the reviews on e-commerce platforms. And if the product has a large number of good reviews, most likely the product is going to be good. So even social validation of the product. So this is why it's a great USP of this experience. Now, what are the confluence of factors that define this inflection point for consumer tech? I think one is fundamental things that India always had, which is the fact that we have younger demographics with a median age of 28 versus 36 in China. Younger people are just more adapt to using new technology. Incomes have been going up. But the big disruption, I would say, the big catalyst in many ways was the cheapest data that Reliance Jio triggered, with tremendous affordability on 4G. And then a number of enablers appeared in the ecosystem, and we'll talk about that in detail. Jack Ma, the founder of Alibaba, was called, what are the key factors driving e-commerce penetration? And he said three things: cheap data, frictionless payment systems, and a great logistic infrastructure. So we all know the experience of cheap data. Let's understand what happens on the other enablers. And so first is the world-class infrastructure. I think India in the last 7 years have created the world's best payment infrastructure. Earlier, many years ago, people would talk about the mobile payment platforms in Africa, M-Pesa, or the WeChat in China. Today's India's online payments are tracking 80% higher volumes per day than China. So India is the defining payments infrastructure in the world. And there have been many enablers of that. One, of course, has been Aadhaar, which allows for online identity, the Jan Dhan Yojana scheme, right? And the India Stack that appeared. And UPI is absolutely considered India's biggest, tech innovation that India has delivered, a low-cost, frictionless payment platform. And clearly, you've seen an explosion of volumes in UPI, and it continues to grow at a frenetic pace even now. So one is the payments infrastructure. The thing that India still needs to improve on is logistics. And of course, prior to the e-commerce, the logistic infrastructure in India, from a consumer post perspective, was largely, the India Post, which wasn't a great experience, right? Which was meant for delivering documents and not very efficient. And of course, some private courier companies that were designed more for businesses rather than consumers. So in the last decade, these companies, the e-commerce companies like Flipkart, Amazon, have created their entire own backend. And then you have now B2B companies like Udan and Geomart doing the same, on their own. And you have in grocery space, your big basket grocers, which are again building great last mile delivery systems. And then you have, of course, we have seen what happened in food delivery with Zomato and Swiggy, the way they have built the quick commerce experience of food delivery in India. So we are rapidly building up the logistics, infrastructure in the country. It's not there at where other developed markets or emerging markets are there, but the pace at which is happening is very exciting. So the key enablers of consumer tech are coming in place. The question then is, what are the key emerging trends in consumer tech? First, you're seeing frenetic activity in tier 2 and tier 3 cities. There, they not only solve the affordability problem, but just the availability problem. You're seeing a lot of small businesses adopting, digital, particularly mobile channels, selling on Facebook, selling on Meesho, and of course, adopting digital payments. You're seeing consolidation and verticalization across categories. Now we're seeing in major categories, key players start emerging, and we'll talk about that in more detail in later slide. You're seeing some players in India having global aspiration. And just before this call, I was listening to Baiju Ravindran and his, vision to build, Baiju's as the world's largest consumer, edtech platform, and particularly the fact that it's building a large business even in the US. You're seeing a formalization of the labor market of drivers through Ola, Uber, and beauticians and a lot of service providers through platforms like Urban Clap, and of course, delivery partners through the host of logistic companies. And you are seeing the emergence of direct-to-consumer brands and digital native brands like Lenskart, Mama Earth, Wolfskin, Bolt, Sugar, already gaining traction. And this COVID crisis has significantly accelerated the adoption of consumer tech in India. As per the McKinsey's global survey, digital adoption is accelerated by 3 years globally, but by 4 years in Asia Pacific. So that's why we're seeing hyper growth rate in large number of consumer categories. So if you're surprised at why you have a large number of unicorns in 2021, is because what would have been got created in 4 years got created in 1 year because of the significant acceleration of digital technologies. So that's the important perspective to have. What would have normally got created in 4 years got created this year in 1 year. And finally, and then looking at the size of the opportunity, often, when we look at the potential markets, we often look at the US for inspiration. India tends to look at US markets. But that's a wrong analogy in our opinion, because US is a very evolved economy with per capita incomes of $50,000, very different, structural elements like expensive labor and reasonably cheap real estate. In fact, the analogy, the inspiration, if you have to look for, is China, because China is in many ways similar to India. So I'll just give example. For example, in food delivery, Indian market has to grow at 20% CAGR for the next 15 years to get to the same level where China is today. And by the way, China has similar population scale as India. So that is the growth potential. So look at China for inspiration when you want to understand the scale of potential markets, not the Western world. And finally, the big question that emerges is, everybody wants to build a super app, right? There's talk of Jio building a super app through its partnership with Facebook. There is, of course, Amazon, Flipkart trying to build a super app, and Paytm trying to build a super app, particularly on the financial services side. However, what we have seen in India is, in particularly in Southeast Asia and China, you have super apps emerged, particularly more in China, because China is a very closed market, closed loop. There are only three large e-commerce giants in China. Fundamentally, uh, while India, right, we have allowed specialist vertical leaders to emerge in food tech space like Zomato and Swiggy, ride sharing, Ola, Uber, e-commerce, Flipkart, Amazon. In grocery delivery, you have big baskets, grocers, even Swiggy entering recently. Payments again, Paytm, PhonePe, Google Pay, EdTech again, Byju's, United Academy, Vedantu. So we are seeing in India a verticalization of the consumer tech space rather than a consolidation. Now, of course, super apps have some strategic advantage. Their customer acquisition costs are low because you can, instead of offering one product, you can offer a bouquet of products to the customer. You create large strength of networks because when customers see a lot of use cases in a single app, they keep coming to the app, and that is a virtuous circle. So you create strong network effects. And then this increases the size of the market at super app, the TAM, and of course the lifetime value of the customer through super apps. But in India, we are yet to see anyone making material headway into building a super app. It's possible that India does not have a super app, and we see a verticalized consumer tech market in India. Finally, question comes to, we are making the shift from consumer tech to fintech. While consumer tech has actually evolved quite a bit in India, and particularly in a few categories, fintech in most spaces is very early stage in India. And the financial services industry can be broken into four broad categories: payments, lending, insurance, and savings. And the revenue model for different business models are different in each of these segments. And the drivers are also different. Already in payments, we've already seen a good deep ecosystem emerge in India with the likes of Paytm, which was an absolute pioneer, to Bharat Pay, PhonePe, Google Pay. You have BillDesk, Pine Labs, Razorpay, a large number of. So this is the most developed part of the fintech space in India. And India, because of the fact of emergence of UPI, it's become difficult to make money in fintech, in payments. So actually the payment platforms are actually are just a funnel for you to use that customer base to sell other products and make money. It's very difficult to make a lot of money in payments in India because of the fact that UPI is entirely free, and UPI is gaining, has even made wallets less relevant in India. The next space from a penetration perspective in India is insurance, where of course you have one large player at an aggregator level. Aggregator has emerged in Policy Bazaar. And then there are very interesting new age insurance companies like Acco and Digit. And this is a space, again, where most players are focused on distribution, because insurance tends to be a hard sold product. So a lot of value is captured by the distributor. And most of the fintech platforms have focused on solving the distribution problem in insurance. The next place where they've seen a good penetration in certain elements of the saving products is particularly on trading and investment. In trading, clearly you have large discount brokers that have emerged. In investment, we have seen a number of unicorns that have emerged, but it's very early stage in terms of even building a fintech penetration in investments. While in equity broking, already the discount online brokers have already taken a dominant market share. And you have a number of platforms that have emerged. We have highlighted a few of them, but we are seeing practically every week a fintech unicorn emerging in the country currently. And then finally, the space that is in very early stages and haven't seen any scale as yet is lending. And lending is difficult. It's a lot more complex business part of the business in fintech, and where we only seen some companies making early, inroads, but you haven't seen any skilled player in lending fintech. Very early stages in terms of evolution. So the question is then, what is the disruption in fintech? Fintech, obviously, if you think of the traditional consumer experience in fintech, earlier, if you wanted to open a mutual fund account, it would take many days to, get an account open. It would take 3-4 days for you to get the account open, then get funded, and then you get the units allotted. If you wanted to open a bank account, submit multiple documents with physical documents. Typical account opening would take a week's time, and it'll be probably a few days before you got your debit card. So the customer experience in fintech has been pretty poor, and large part of the country, because fintech was financial services was largely related to availability of branches. So large part of the country, the fintech products, the financial services products were not even available. Forget about their, pricing and convenience and all. And fintech through online, availability, and the fact that they're delivering great customer convenience and delivering a great experience. Today, they are able to solve the problem that traditional banking BFSI companies can't service because of the high cost of operation of physical businesses. BFSI companies cannot service a certain class of customers, which tech companies can. And of course, people are building today. Historically, in India, products got built for India. Now, people are building simple to use product built for Bharat, not only for India. So clearly, the clear use case lies, and India anyway has a very underpenetrated financial services market. Whether you look at in terms of number of bank accounts, when I mean active scaled bank accounts, to insurance product penetration, to investment product penetration, whether mutual fund, unique mutual fund customers, or demat accounts or stock broking accounts. So clearly, fintech is there to solve the problem. And if you look at the evolution of fintech in India, we've gone through 3 phases. The first phase from 2000 to 2014 was fundamentally a phase of payments, because that's where India has created now a very skilled sector, and most large fintech players that have emerged historically have come in that era from the payment space. Companies like Paytm, you have BillDesk, Razorpay, Pine Labs. The couple of exceptions are Policy Bazaar and Zerodha. Then you had this phase 2 of lending businesses that have emerged, but unfortunately, not many of them have scaled, as yet in the lending side, and we'll talk about that later. So you had companies like PhonePe, Off Business, Grow, and Digit emerge. Yeah, most of the peer-to-peer lending platforms are still very small, and actually completely till now not relevant in the financial services ecosystem. And this last 3 years, you have seen the emergence of enablers to fintech. So you have companies that are account aggregators, companies which are neither selling investment products or lending products or even providing payments, but they are existing as enablers platforms. And of course, the couple of them that we know and scaled up is BharatPay and Cred. They're actually created Cred particularly has created customer communities, to which now they are acting more as a distribution platform. And of course, we had this start of the neobanks with Jupiter. Again, these neobanks fundamentally have a traditional bank at the back end. But today on a neobank, it's possible to open a bank account in less than 10 minutes. Versus still a physical branch takes still a week to open a bank account. And the young people just like the customer convenience of 10 minutes to open an account. And finally, what are the kind of monetization models in fintech. So fundamentally, fintech has three broad categories of monetization models. The first is you make money on transactions or assets. So which is how Zerodha operates. You make money on commissions, or you make money on assets, which is an asset management platform like Grow does. Or you have, or one which makes on transactions is Policy Bazaar. When people buy insurance, they get paid commissions. So first is a transact fee on stock and flow. The second business model is you make money on net interest margin or underwriting. There you have products, platforms like Lending Card or ACCO. ACCO is the new age insurance company. And the third model is companies which actually provide either SaaS or PaaS-based product solutions, right? Which is companies like Zeta, ClearTax, OkCredit. And within this, there are companies which operate in multiple such monetization models. So when I'm saying this, you can clearly see the companies which are operating at intersection of all the three, right? So companies are building different kinds of products where their products, where they make money on transactions, their products, they make money on SaaS, PaaS, and their products where they make on lending on an underwriting margin basis. For example, Paytm has all the three business model built into its business model, the three monetization models built into it. And finally, the big opportunity and the undertapped opportunity is digital lending, which is as of now practically negligible in India on the fintech side. So if you think about fintech, typical traditional lending is you get customer experience from one bank. They underwrite the risk and they then keep the risk on their balance sheet. However, in fintech, you can disaggregate all the three characteristics. There can be platforms that can acquire customers and deliver customer experiences. Then there can be specialist platforms that provide underwriting tools. And then the risk can be housed in another entity, right? So you're disaggregating the whole lending value chain. And the competitive advantage of a fintech platform is that one, they can deliver a great customer experience. Number two, they can use a lot of data to underwrite, to improve the underwriting. For example, a good fintech, even the phone pays and all, just know about your every transaction. By the way, these apps all read all your SMSs, including their non-SMSs. So they know your bank accounts, what transaction happened, when your salary credits, whether you got last month's salary credit or not, how much did you get salary credit, where do you spend money, So they're able to get, and of course, they know your social media history, even the credit profiles of your friends on social media, they're able to map, right? So this is clearly, they can use all the data. Unfortunately, a traditional bank does not even use the data of the customer behavior they themselves have to underwrite. They just use the credit underwriting score to underwrite risk. So imagine banks which have all the data and yet use a third-party scoring, credit score platform to write risk. On the other side, these companies are able to use a large variety of data sources, including the third party, to better understand the customer and then write the risk. The places where these two companies, where fintech lags, is collection infrastructure. And particularly if you want to build a scaled lending business, you have to create collections infrastructure. This is the place where clearly the traditional banks are a lot more experienced and have capabilities on the collection side. But in a lot of parts of the value chain, the fintech is, and the other space where traditional banks are well placed is the cost of funds. And let me explain you what kind of spaces in lending will get disrupted by fintech and where it is less likely to happen. So if you look at all kinds of lending, you can put them in 2x2 metric of sensitivity to interest rates and sensitivity to availability or the turnaround time, right? In certain products, customers are very sensitive on the cost of funds and they don't need that product immediately. For example, think about home loan. You don't need home loan in 5 minutes. because that decision to buy a home anyway is usually a few months decision for a lot of people. And because it's a large amount, you're very sensitive to the interest rates you pay. At the same time, when people are spending money on a consumer durable, which may be 25,000 rupees, or a BNPL product, which may be much lesser ticket size, they're less sensitive to interest rate because even a couple of percentage points of interest rate doesn't add up much. You'd rather get the loan in 2 minutes rather than spend 30 minutes or 1 hour getting processed the loan, or maybe more with a traditional financial. So that's why in categories where interest rate sensitivity is low and turnaround sensitivity is high, we believe that fintech has the ability to disrupt those. And the original fintech in India, the real original industrial fintech in India, Bajaj Finance, which is the one that has used a lot of technology, is the one that has actually succeeded in these categories, right? They are the leaders in consumer durable financing, done exceptionally well in personal loans, and BNPL in many forms is what they've done in consumer durable financing. So there's a proof in the past that what kind of segments in lending can scale up. So finally, the question is what you need to do succeed in lending. Who is going to win in lending businesses and fintech? Companies which can underwrite credit well based on using data and their experience. They have to have low customer acquisition cost. Your cost of funding has to be lower because you have to be credible. You have to be able to tie up with the right bank partners. You have to create repeat usage because remember in online fintech, the transaction sizes are small. So if you have only infrequent transactions, you're unlikely to make money off the customer. And you have to build an efficient collections regime, which is pretty ingent for companies. And finally, coming to the investment side of fintech, clearly investment side of fintech, we've already seen the discount brokers take the dominant market share in stockbroking. And that's been an amazing phenomenon in the last 3 years. The way they started and completely from a low teens market share to now 60% and growing market share. And the traditional brokers have got disrupted. And we've seen, despite the fact that they've charged very low commissions by traditional brokers, these companies, because the fact that they don't have physical infrastructure, offer a completely tech-enabled systems, are still able to demonstrate very high profitability. And this has happened because these companies have delivered product innovation, a great customer experience, unlike traditional brokers. So clearly this industry is one where fintechs has seen the highest success. And finally, insurance. And we saw the insurance IPO this week. Clearly, they've demonstrated that insurance is a very difficult industry because the product is complex. The distribution is also very complex. And it's very difficult to tell people you have to buy insurance. Nobody gets up and says, I want to buy insurance tomorrow. Unlike people saying, I want to buy an iPhone on my next birthday. Nobody says, I want to take a nice life cover on my next birthday, right? So insurance is a product that's hard sold. And insurance companies, have strong, brands now, particularly the large insurance companies. And yet you've seen a reasonable success by one player in creating insurance, become a distribution platform for insurance products. They have also started building customized insurance product using their data. And then, of course, the two digital native insurance companies that have emerged in the insurance space in India. So finally, we talked about all the opportunities. Now let's talk about risk, right? So, what are the risks in consumer and fintech? See, I think it's easy to, as I said, sometimes it's easy to be right about what is going to happen in 10 years and 20 years, right? But in the short term, we may overestimate, the market sizes, and so that's one of the biggest risks that we may do. Some of these companies may grow too fast, too soon, without creating a profitable underlying customer base. And so that is one of the biggest challenges. And because of that challenge, you might end up overspending money on customer acquisition. You may have very high customer, less attrition rate or low customer loyalty. And because of that, your long-term value of the customer acquisition cost may be suboptimal. Other risk, particularly more in fintech and less on consumer tech, is the regulations. And this is a very early space, and you can see regulations playing spoiled sport in the short to medium term in some of these sectors. So it's not clearly a given that despite all the opportunity we talk about, there are a multitude of risks that these companies have to navigate in the next decade. And finally, the question that emerges is valuations. And instead of calling this presentation as opportunities, challenges, I've called it opportunities and valuations, because a lot of you think that I understand all the opportunity, but the real challenge is valuation. And we've seen a lot of comments on Twitter and all. Why should you invest in a loss-making company, right? Why should anyone in their right mind should invest in a loss-making company? And let me give you an example. One of the greatest e-commerce companies was loss-making in the first 15 years of its journey. And I quote this quote from 1997 annual letter of Amazon. When forced to choose between optimizing the appearance of our GAAP accounting and maximizing the present value of future cash flows, we will take the latter. So ultimately, businesses are not about current profits. A valuation of a business does not represent the present. It represents the future, the present value of future cash flows. So just because a business is making losses today does not mean it will make losses in the future. Similarly, if a business is making profits today, there is no assurance those profits will remain a few years down the line. And we've already seen that happening in a variety of industries. Those profits are getting disrupted. And now let me give you a slightly different view of this. See, when you think of the last century, the value of the large part of the value in the world lied in real estate and manufacturing assets. And that's why companies used to get valued on book value. And then slowly the value started shifting to brands, management capabilities, systems, right? And in the last 20, 30 years, the value has largely shifted from real estate to intellect, from physical good to intellect. Today, the world's biggest companies, the most valuable companies, own very little asset. Think about Meta, which is Facebook. Think about Google. They're basically ideas and intellect. The business doesn't actually practically require very little assets in the business. Because the value has shifted from physical items to ideas and intellect. However, the traditional accounting, and I'm a chartered accountant by education, tends to measure, if you build a factory, they don't consider it as a loss. But you invest in a brand or you invest in a great technology, they consider that as an expense, and that creates a loss. Remember, when you build a factory, the money goes out of your bank account, but it creates a productive asset. Similarly, when you build a brand or build a great technology, even then money goes out of your bank account and you're actually building an asset. A great brand or a great tech is an asset. However, due to the failures of traditional accounting, one shows as an asset, another shows as a loss expense. And that is why when these companies don't build factories or physical assets. What are they doing? They're investing in brands, building a brand, building a great customer experience, acquiring customers, right? These are all intangible assets. And because of traditional accounting, they get charged off the P&L. It looks like these companies are making losses. What really matters is what is the quality of the brand, technology, or customer experience they're building. If you're building a great set of loyal customers, that is a very valuable asset intuitively, whatever the P&L shows, right? So one is just that the traditional accounting distorts the financial statements of these companies. Now, that's why, value these internet businesses or fintech businesses. See, what happens is a typical fintech company makes revenue, then their variable cost, they generate a contribution margin, which is invested in either acquiring new customers or improving the customer experience. And then to acquire customers and reduce the churn of the existing customers. And then that eventually gets monetized. And then again, those cash flows get invested. That converts into revenue. That converts again a more investable cash flow. And again, that's reinvested. In the early years, because these companies are growing very rapidly, they don't have old customers who are profitable to them, who are generating enough cash flows to invest in new customers. So that is why these companies in the early years have to get funded by equity investors. Only when they get to a significant scale that the existing customers are so profitable that they can generate cash to grow the business, which is what a traditional company does. So the early years, these companies prioritize growth over profitability. Early years, these companies prioritize growth over profitability. They spend significant amount of money on customer acquisition and building quality services. And they are in the habit formation stages where they are investing in customer experience. As they scale up, they reduce the cost of customer acquisitions as habits get formed. Today, for a lot of us, nobody has to tell us to order something on a Swiggy or Zomato because it's become a part of our habit to order online food, right? So while a few years ago, we had to be told there's an option to order food and there are a lot of good options available to order online, but now it has become a habit. So moving on to how do we value new age businesses? We believe that the fundamental philosophy to value businesses does not change, whether for new age companies or other businesses. At White Oak, we use the three key attributes to identify great business: superior returns on incremental capital, scalable long-term opportunity, and strong execution and governance to identify any great company. So while the philosophy does not change, the tools and lenses that you use to measure these attributes change. So to identify superior returns on incremental capital, we're looking at nature of structure, competitive advantage. We're looking at unit economics. Scalable long-term opportunity, we're looking at the total addressable market and the monetization opportunity. Strong execution, we are looking at trajectory of customer acquisition cost, engagement metrics, what is the quality of network, and what is the evolution of the network characteristics. So ultimately, we are trying to identify whether the companies have recurring revenues, whether they are generating customer delight, are they building ecosystem, and finally, are they creating viable economics, which is how you look at fundamentally every business. Just the tools change. So how do we look at the efficiency of an e-commerce or a fintech model, consumer tech or fintech model? One, we like to estimate the size of the market. Scalable, you want to invest in businesses which are highly scalable over long term. So categories which are very underpenetrated and have large growth potential. Number two, you want to understand the efficiency of the business model. What is the cost of acquiring the customer, which is called CAC? What is the expected lifetime value of a customer, which is called LTV? LTV to CAC ratio is the key ratio to understand what is the underlying economics in the business. And LTV to CAC of 2 is a good business. 3 is a phenomenal business. And by the way, one of the consumer tech companies that's currently listed in the Indian market has an LTV CAC ratio over 3. And that's why it's going to be a phenomenal business over time. And you want to understand the nature of the competitive advantage. Is it because of scale and the scope? Is it because it has become a network effect? This tremendous network effect has been created. Or you have created a brand. See, one of the advantages I tell about Paytm is Paytm has become a verb. When people say Paytm kar dena, it means that you make an online payment, right? It does not mean that you would only Paytm, right? So have you created a brand that is, because that itself, we believe that people trust you as a platform and you have an opportunity to sell other products over time. And finally, we also look at ongoing execution. Again, these same metrics, whether your customer base is organic or paid, where are the sources of traffic, whether your customer acquisition costs are going down, how are your customers behaving, what are user retention rates, what are your high users doing, what is the depth, what the number of depth of your platform. For example, in someone like Swiggy and all, would say how many restaurants are available, how many customers are available, whether your supply is fragmented, whether your demand or supply is fragmented. For example, in insurtech platforms, supply is reasonably concentrated while demand is very fragmented over millions of customers. What is the pricing power? Best platform is where both demand and supply are fragmented. And pricing power, and whether customers use multiple platforms. So these are the metrics we track. And finally, let me give you an example of how customer economics work. See, let's say you have a customer that is going to be with you for 4 years. It has a churn rate of 25%, right? And that customer, your cost of acquiring the customer is 100 rupees. And so the first year you generate 80 rupees of gross value. So you lose money of that customer. And next 3 years, you generate 80 rupees of gross value. So your gross LTV, which is the total contribution you've generated, is 320. Net LTV is 220. So 220 is basically after your 100 rupees of investment. So that means every 100 rupee you invested creates a value of 3.2 times on a gross basis over time. So this business on your left is extraordinarily profitable and value creating. On the other side, a business which has low frequency of usage, lower ticket sizes, and low gross margin, right? Actually has an net LTV CAC ratio of 0.6, and actually is destroying value over longer term. So if this company on your right is growing, long term it will destroy value. It's going to keep sucking more investors' capital. The company on your left side, if it grows rapidly, it will create tremendous amount of value over the long term. And that's why it's important to understand this. So finally, I've already taken more than my share of time in the formal presentation. So finally, on the last slide, the internet economy is here to stay and grow larger. And this will become a large part of the markets. Technology is going to disrupt traditional businesses, and a new digital native mobile first companies are emerging at rapid speed. They're coming with variety of business models. Technology has the track record of creating large winners and losers. So technology tends to be a high alpha sector. And that's why as investors, we like it, because we are focused on creating alpha. And finally, in our opinion, the valuation framework for these companies don't change. The value of any business is the present value of future cash flows. Many of these companies today are in habit formation stages and are showing accounting losses. But what really matters is long-term cash flow generation, not near-term accounting losses. And I just want to give an analogy. All of us study, at least study 15 years in our lives, right? We don't generate any cash flows in 15 years. We actually incur losses, right? For 15 years. But nobody thinks that's a bad investment, right? Because everybody knows that the next 40 years, you're going to generate tons of cash flow. So that's the same perspective you need to have. It does not matter what happens to near-term cash flows. What matters is that money well spent? If you're studying and if you're a post student, if you go to extremely good colleges, but you don't pass exam, you're not studying, then that may be a poor investment. So that's how, and as humans, all of us consider education as necessary and a great investment. That is the same perspective we have to look at. Finally, at White Oak, we are focused on investing in consumer tech and fintech companies which are dominant in their industry, have positive unit economics, are serving large and growing markets, and are run by credible management teams. And we like, even if there's an extraordinary great company, we will only invest with them if the price is right. We will always maintain a valuation discipline. And the 2 IPOs this week in fintech prove that there is a method in the madness in markets. where there is a sustainable competitive advantage, which is kind of where a clear leadership has emerged and people are sure of the unit economics, people are willing to ascribe value, right? So it's not like markets are bidding up every company at any price. There is clearly, method in the madness. So I'll stop here because I know there's going to be a lot of questions. Thank you.
Right. We'll open up for Q&A. Anyone who has a question, please write it down in the Q&A box and we'll take it up from there. Ramesh, till the questions come in, 2-3 very important or key questions which everyone would have. If you take the recent IPOs, let's say you look at Zomato, you look at Nykaa, you look at Policy Bazaar, and you look at Paytm today. How do you see valuations for these companies panning out over the next few quarters, with people saying that Nykaa is probably more valuable than quite a few traditional businesses which have been there in India?
So one, Devashish, there's no point discussing valuations over the next few quarters because that's absolutely less relevant in our opinion. What really matters is, look first from our perspective, the competitive positioning of these companies, whether they are defined industry leaders, are they facing significant headwind, or they are oligopoly structures, right? And all the 4 companies face a different set of market. Clearly, it's easier to understand that Nykaa and Policy Bazaar are more stronger leaders in the spaces that they operate. Zomato and Swiggy are extraordinarily head-on with each other. There's a tough fight between the 2 companies, both are neck to neck to each other. And in Paytm, while clearly Paytm has been a pioneering company in building the digital payment system, but because of the emergence of UPI, the wallet space has become less relevant. And in UPI, the market leaders are PhonePe and Google Pay, right? So while still Paytm has a very large user base, and payments in India, because of the emergence of UPI, it's difficult to make money in payments in India, particularly from the consumer side of the business. So anyone in the payment space has to use the customer base of the payment business as a funnel to sell you a lot of other products. And I'm sure you saw those ads of PhonePe in the IPL, where they started selling insurance. So, so the payment business is a funnel to get a large engaged customer base that you can over time sell a lot of other products. And the challenge for someone like Paytm is going to be whether they can monetize the large customer base that they have on payment side, over time. And there are tough competition in some of the sub verticals in financial services. For example, there is a number of good discount brokers in securities trading. There is some players on the asset management side, we're still pretty early times. And of course, insurance, they have a very strong incumbent now for Paytm. So, but there are still very large white spaces in lending where there's no skilled player in India of any scale related to the market. So it has to be for Paytm, they have to build a strong competitive advantage and find a way to monetize the large customer base. While for someone like Nykaa or PB Fintech, that has been more solved by them. And Swiggy and Zomato are head-to-head, fight competition. So that's why the competitive spaces are very different. Market sizes are also very different. Food delivery is going to be large. There's no doubt about that. Similarly, fintech is a very large opportunity. The challenge for someone like PB Fintech is also whether they can grow from insurance to other spaces within the financial services. And Nykaa, of course, is already doing well in beauty and also started doing well in fashion. They seem to be executing well, and whether they can still continue to grow their TAM over time. So I hope I've tried to answer that question.
Sure. You mentioned people building super apps, different companies trying to build them. We've also seen Bajaj and Tata's also try to build super apps with their acquisitions and various forms and manners. So how do you see this panning out? Traditional economy vis-a-vis new age economy?
So the super app success is largely a more dominant China phenomenon and some success in Southeast Asia. Otherwise, nowhere in the world you have super apps. In China, you have complete closed ecosystems, right? Where people, if they are a WeChat customer, they tend to do everything in WeChat, right? So then they don't go out of that ecosystem and they buy a lot of products, whether whether fintech or consumer tech or e-commerce, even order your cabs within the same app. So they've created these mega apps. The typical app that can become a super app typically has to be a messaging app. What is the app that you open the most on your phone? I can bet for India, most people it will be WhatsApp, right? They are not. Then others, the second choice app of our choice may be very different for different set of people. But the first app in India is WhatsApp. So anyone to have build a super app, you have to have an initial app that has a very high engagement with the customer. And WhatsApp is extraordinarily well positioned to do that. But at the same time, one of the interesting dynamics that's emerging in India is we are seeing extraordinary high quality vertical specialists emerging in India. So the question is, if you want to order e-commerce, and let's say I'm just making it up, one of the super apps doesn't have a partnership with Amazon or Flipkart for whatever reason, their types. But you know the best e-commerce platform, and you want to use Amazon and Flipkart, which you think are the best e-commerce platform. Then whether you would stay on that app or just open Amazon app and order on that, right? Similarly, if you want to book your flights, whether it's going to be Make My Trip or some other suboptimal experience, or similarly for food delivery. So I think in India, we already created high quality vertical specialists. So to see whether the consumers are willing to accept slightly low quality experiences within the super apps, right? And too many people are trying to build a super app in India. Even Amazon is trying to build, Flipkart is doing through. So, and of course, ambitions of a lot of players. And so it's going to be extremely challenging. The customer will get spoiled for choice. We'll have to see how customer behaviors evolve. But you understand, even in US and Europe, we don't have super apps. So it's more likely India goes the rest of the world way rather than the China way.
If there are any queries, please type it out in the Q&A box. We'll take them up. One more query which comes in over here is, with the amount of fund flow which is going into all the apps over here, does that also distort valuation to a large extent? Or do you see fund flow continuing and people discounting earnings rather than 4 years going down to about 5 years, 7 years, even longer?
So see, as we said, right, the important catalyst for emergence of a lot of unicorns in India is the fact that digital adoption has been accelerated by 4 years. So what was supposed to happen gradually over a 4-year period has got time crunched into a year, because suddenly the pandemic has forced behavioral changes, not only in India, but large parts of the other parts of the world also. And that's why you're seeing in a short time, large number of unicorns emerge. And of course, a lot of capital flowing into it, because now everybody understands that, in the initial months of the pandemic, you didn't know how long the pandemic stays. But we've experienced it now for more than a year, right? And because of that, they've seen a structural change in behaviors. Like, for example, EdTech, education tech, was in very nascent stages and and secondary use earlier. But EdTech has become a primary now because of the disruption to education because of the COVID. And a lot of these behaviors are here to stay. So what you're seeing, this explosion of capital and startups, is simply because there is rapid scale up that has happened. And number two, the customers have what? Number two, you have build this beautiful payment stack in India. With the fact that I'm sure you've seen this on Twitter, even on buffaloes, there is this on bulls in South India, you have the QR codes. That's the pace at which we are adopting technology. So one of the biggest pain points of consumer e-commerce in India, which is cash on delivery, which is a very expensive solution in India, has become less a problem, right? And so you are seeing this acceleration adoption. Yes, capital is going in. There is going to be large winners and losers. So all these unicorns that emerge, a number of them will fail. When I mean fail, they will not achieve the objectives, they'll get acquired, they'll merge. And some of them will surprise at how big they become in the next few years. So it's going to create large winners and losers.
One last query from me. In your presentation, you had mentioned two startups in terms of CoinDX and Kuber in terms of the crypto exchanges. How do you see that entire space panning out going forward?
See, I'm just no expert in crypto. While I'm a technology investor, I understand blockchain, and the coins are one of the applications of blockchain, right? Of course, there is clearly an alternate decentralized finance that's emerging. It's very exciting. It's restructuring the way finance is emerging. And some of these platforms will find usage in the new architectures that emerge. This is a great technology solution to some of the old technology problems we are facing, the whole crypto platforms. But if some people call these as currencies, I have an issue with that. Because currency is a traditional. See, I'm going to basics of currency. What is currency? Currency is a medium of exchange and a store of value. If you have such insane volatility, how can it be a store of value or a store or a measuring tool, right? Right. Now, anything that you have to measure itself has to have low volatility, right? So I have doubts whether it is a currency. Is it digital gold, a form what is called the digital version of gold, right? A scarce asset which doesn't get produced enough. That's probably true. But mind you, for everything gold, there were a lot of other metals that didn't create value, right? So there'll be probably some crypto platforms that will create value, but there'll be a lot of stuff people will figure out they were actually iron and ferrous metals that they ended up buying over time.
Sure. Thank you, Ramesh. I think we've covered everything over here, and thank you for this insightful session over here. And if there are any questions, I think we'll mail them off to you and we'll get a response over there. Thank you everyone for joining us over here, and a recording of this entire webinar will be shared with everyone. Thank you, Ramesh. Thank you very much.
Thank you, Devashish, and thank you, Team Avendus, for hosting me, and thank you for all the participants for this webinar. Have a nice day.
Thank you.